Give me 1 second, guys. Alright, guys. So, people ask me about volatility. And volatility crush for options and wondering why their options aren't worth as much after earnings. Well, there's a pretty good explanation for that. So, there's two types of volatility. There's implied volatility and there's historical volatility. Implied volatility is the estimated volatility of a security's price. Generally, when there's bearishness in the market, the IV, or implied volatility, increases. And they believe that the price will go down over time. Excuse me. Now, the IV will drop once the market settles and the security starts to go back up. Now, historical volatility is the measure of volatility of the underlying stock or futures contract. Now, historical volatility is already known because it's happened in the past. So it's a measurement of past volatility. It means nothing going forward. It's just an estimate, or it's known volatility from the past. All right. So we're going to look at Celgene's chart right here. And Celgene's chart. So pull that back up. Sorry, bear with me. All right, Celgene's chart. All right, so right here is when Celgene announced that they were going to stop development of the Crohn's drug. Pretty familiar with that. My brother has Crohn's. So you see huge gap down to 124 from 135. That's a big gap. Also, you can see blue line's historical, HV30, historical volatility. It's the historical volatility over the last 30 trading days. So, obviously I have data for many, many days, but it's calculated off the last 30 trading days. And the red line is the implied volatility, the current volatility for the last 30 trading days. So, you can see when the price dropped, volatility increased. See, the historical volatility increased. That's calculated, it's known. The red line, the implied volatility, increased as well. Also, it was a binary. Implied volatility will increase during a binary event, which there's one of two outcomes. It's a good earnings call, it's a bad earnings call. So you can see implied volatility rallied into the earnings call, and after the earnings call, it fell off. So if you would have went long, puts you might have been okay because it was bigger than the expected move. Now, if an options price moves bigger than the expected move, you might be okay. But once the volatility starts to fall off, it's known as IV crush, and your options will become cheaper. There's nothing. Sellers will benefit, buyers will be crying. Here's a better example. The earnings call that just happened recently. You can see IV kind of increased. Not much, but 33, 34, 32. And now it's all the way back down to 29. And it probably still has farther to go. But if you were near weak options and you sold options, you were a winner this time because volatility dropped. Sometimes it'll increase a little bit, and if it's bigger than the expected move, options will be okay. It's not worth the risk, in my opinion. You might as well sell going into earnings call, sell a credit spread or sell an iron condor, and try to take advantage of the IV crush. But the IV crush is when the implied volatility drops after a binary event, such as earnings. So the expected move is basically an at-the-money straddle times 0.85 to account for skew. So I hope you enjoyed my video on IV crush. But next time there's an earnings call, paper trade, and you'll see what I mean by IV crush. It's quite the phenomenon.